Let's pick up on the markets now. The local bourse set to open to positive global trading this morning, with riskier assets still showing signs of recovery after recession fears spooked investors. Matete Thulare is head of foreign exchange execution at Rand Merchant Bank. Joins us now to talk us through some of the market developments. Mr. Thulare, thank you very much for your time. Top of the morning to you. Give us a sense of how the JSE is performing in early trade, particularly the local currency. How is it faring against major currencies?
Good morning, Polly. I suppose as we close to wrapping up the end of June and obviously the first half of the year, the Rand has weakened slightly this week, obviously trading near the 16 handle to the dollar. Obviously, as the risk of sentiment has taken hold, especially after Federal Reserve Chairman Jerome Powell obviously acknowledged the risk of a recession. Now, Jerome Powell was speaking in a testimony to U.S. lawmakers earlier this week that the central bank is fully committed to bringing down, which is, the new buzzword, inflation under control, even if it means doing so with the risks of an economic downturn. So obviously that will bode not too well in terms of sentiment globally, especially for risk assets such as the Rand. And locally also, the attention is really focused to the increased risks to the country's strained electricity supplies, especially amid the earlier report that you alluded to with regards to the protests that are happening by some workers at Eskom. That is obviously not going to bode well, especially for the growth sentiments for the country. And beyond that, also, if you look at the weak Rand, that has driven the month to date under recovery in the petrol price to nearly 2 Rand a litre. So what does it mean from next week, Friday, on the 1st of July? Potentially we could see, an increase in petrol prices again. This is over and above, obviously, close to the 50% increase in fuel prices that we have seen this year. So oil prices are really being supported by the persistent strong demand that is being seen amid the potential European Union sanctions on Russian oil.
Well, talking about Russia, we are 4 months into that war in Ukraine. Do you think the market has priced in a prolonged war at this point?
Well, Cody, I think you just need to cast your mind back to two things, especially over the past 24 months. We've had two really big uncertain events really hit the global front. The first one being the COVID-19 pandemic. The second one being obviously now the geopolitical tension out in Eastern Europe. Now, some interesting facts about all of this is that the Russian army is unlikely to return to its full force in the near future after it actually incurred significant losses of troops and military equipment during the 4 month. As you said, it marks the 4 month since the start of the war, before Russia invaded Ukraine exactly 4 months ago. Their country's army was ranked the second best in the world. Now, as a result of the invasion and obviously the Western sanctions, the Russian military has lost advantages in both personnel and equipment. Obviously, this will take years to regain. But when you look at the world economy, we are actually going to pay a hefty price. We are still, factoring in and pricing in a prolonged situation out in Eastern Europe. But for the war, this is obviously going to encompass weaker global growth. It's going to mean higher inflation, and it will have, long-lasting damage to supply chains across the world. Now, the price of the war could be even higher, describing obviously the long list of risks that I've mentioned, including the fact that there could be an abrupt cutoff of Russian supply into Europe with regards to gas and oil, and also how this will actually factor through into the financial markets, from high debt to also elevated asset prices for some of these commodities. Now, if you also think about it, some governments are starting to rethink their spending plans as they attempt to shelter some households from all of this. We've seen this out in Germany. We've seen out in Ecuador. We've also seen it out in the European side in terms of London, etc. So the early effects of these surging prices have already also forced central banks to think differently. They also have to now start hiking interest rates even much more aggressively. You've seen the likes of the Fed. You've seen us locally as well having to put the brakes on. So it just shows you that up until this war ends, there's obviously going to be a lot of moving parts up until it stops.
Yeah, well, let's continue the conversation around oil prices. The understanding is that the trade is happening sideways this morning. This is amid the supply and demand uncertainty, as OPEC Plus is still expected to boost the output from this month. Talk us through that sentiment.
So as we've been monitoring oil prices over the past couple of days, I mean, oil has felt its lowest level in over a month. But that's been really pulled down by concerns around the global economy as to whether we could slip into a recession later this year or in the first quarter of next year. The other additional headwinds for oil come from the stronger dollar, obviously, as a lot of investors are leaving emerging markets and obviously starting to invest in safe haven currencies such as the dollar and gold. Now, a slowdown in global growth is a risk to the oil demand prices, which could obviously help ease some of the tightness in the market that we are seeing. Already, we've seen demand estimates being revised lower over the course of the year, especially with regards to, obviously, the recession that could potentially play itself out. But whilst this may help to ease somewhat the tightness in the short to medium term, it really doesn't do much for the longer-term supply shortfalls. Now, there's also been renewed lockdowns in China that have also raised concerns about, the oil demand recovery in the world's second largest consumer market. But also, when you look at the other side of the coin, is that traffic data out in the U.S., it's suggesting that demand is already experiencing a steady recovery. President Joe Biden is already asking Congress there to suspend the gasoline tax. If you think about it, it's actually the same ploy that we've, employed locally with regards to the general fuel levy that Minister Mantashe and Godongwana have also put into play. This could ultimately boost demand out in the U.S., encouraging consumers to travel more over the summer holiday and obviously try to boost this global growth story that we keep talking about. As we know, the European market, the Northern Hemisphere, they're going into holiday season. So if you do have that demand for travel, that will at least somewhat ease, global growth sentiment as well.
Yeah. Let's talk company news for a bit. Platinum miner at Northern. It's been granted the right to give evidence at the merger hearings between Impala Platinum and Royal Bafokeng Platinum. Might this be a sign of further delays in that takeover bid?
So this is quite an interesting one because, what's happening out in the northwestern province, it's quite, as you said, delayed, feels like the name of the game. So Northern Platinum will be making limited submissions in terms of a written and oral submission on the alleged potential harm of the merger, including the effect on competition in the local upstream market for the production and sale of concentrate, to the extent of how the merger effects could hamper junior miners. Now, Implat has wanted to wholly acquire Royal Bafokeng Platinum for some years now. It's been something that has been a back and forth deal. But just as the deal was about to, look like it's going to happen, Northern came in and they acquired about 32% shareholding in RB Platinum last year at a premium price on top of that. So Northern has grown their stake to about 35%. Impala also has a stake in that similar region. But obviously what's going to happen with the Competition Tribunal is going to be quite an interesting precedent that will be set for how, especially when you look at how a lot of the mining companies are at this point in time, given the high commodity prices, they are reducing their debt. They're also going into the market and doing quite a lot of M&A transactions. So how this plays itself out is going to be quite an interesting one, especially given the fact that this has been delayed for such a long time.
Yeah. Let's conclude the conversation with activity levels and, if you like, confidence in South Africa's construction sector. That's said to be declining again. Talk us through the findings of this latest Afrimet Construction Index.
So the ACI, the Afrimet Construction Index, it's a composite index that obviously measures the level of activity within the building and construction sectors, and it's obviously compiled by economist called Dr. Buerta on behalf of Afrimet. Now, some of the findings there include the fact that the lifting of the COVID-19 regulations, a few months ago, obviously has resulted in a V-shaped recovery for most sectors in the economy during the second half of 2020, including construction. But, as we know, several sectors have fully recovered, and obviously they are progressing to a new phase of expansion, but construction really remains subdued. And I think some of the factors that are driving the construction segment of the market includes the high interest rates and the low economic growth, the poor confidence in terms of investor sentiment in the country with regards to a topic that you touched about earlier with regards to state capture, the public sector incompetence, and obviously the high levels of violent crime that are seen sometimes in the construction sector. So as long as the value of construction work in this country represents only 4% of the country's infrastructure project in terms of pipelines, new jobs will not be created at a faster scale in the construction sector to actually even create enough jobs for the country. I mean, if you just think about it, there's a lot of work that needs to be done, from rail in terms of road, transport, logistics, etc. in the country, and also building up of new factories. I mean, just for us to actually get a lot of jobs, we need to build quite a lot of factories, but also you need the international community that is obviously focused in terms of what's happening around the world to come to the fore, but also you remember that, we've had the KZN floods as well. So there could also be scope for some of the construction companies to actually step in and alleviate the infrastructure projects that government has said they want to spend on. But obviously, as we all know that government's pockets at this point in time are limited. So it is going to be quite an interesting time over the next few months to see how the infrastructure projects and also construction in this country goes forward, given the fact that it is one of the major sectors that we need to really propel in terms of creating new jobs.
Matete Thulare, thank you very much for that markets update. Quite comprehensive indeed. Head of Foreign Exchange Execution at Rand Merchant Bank.